Throughout my career, I started out in investment banking, did that for about 7 years, and then transitioned into private equity real estate. So I've been on the principal side for the last 15 years. Started in the business working for a family office, and then transitioned to medical development, oversaw the capital markets group, raising debt and equity predominantly through family offices. And then prior to founding RyCore Capital, worked for a large bank in their wealth management group, basically deploying client capital into income-producing real estate, office, industrial, retail, medical, apartments, just about everything. And then in 2019, decided it was a good time, had a decent track record to go out, and so RyCore Capital was formed in 2019. We're a multifamily office-backed firm. We have 3 families behind us, and they were essentially the capital for the first tranche of transactions. We've since grown to, in 36 months, about 2 million square feet of office, industrial, retail, medical, across primarily Texas, but then the Sun Belt states. Been very active, and really what we do is we offer a two-pronged platform. Number one is we will sponsor asset-specific commingled funds for value-add income-producing assets in the office, industrial, and medical space. As I said before, we started where it was just family office money, and now it's transitioned. We have 3 or 4 JV institutional partners, and so we're built out a team, and we kind of go out and try to find deals, and we're the GP, and we typically invest 20 to 30% of the equity ourselves, so we're highly invested in those deals. And the other piece of our business is what I believe is unique in the sense of we do direct investment advisory for clients that don't want to be in a fund, right? They want to own their real estate. They don't want to deal with the GP. They want to have control. But how do you do that, right? How do you build the infrastructure to do it yourself? And so we kind of fit that void in the sense of we will sponsor investments for them, put our portfolio management hat on, build a portfolio for them, and then manage that investment on behalf of that family. So that part of our business has grown rapidly just because of the evolution of today's real estate investor. While funds will always be needed, I do, we've just seen a gravitation to folks that just want to directly own real estate. But yeah, that's what we're doing.
Yeah. Hey, all, Dan Kryzanowski. Been in the real estate space for about 15 years, way back when with GE Real Estate. My wife and I, we beat the trend, came to Austin in 2011. Have been in a mix of real estate tech, which is also known as prop tech, have been a passive investor even prior to the crowdfunding days. And with the company locally here, Rocket Dollar, for some of us that were here in person a few years ago on a fintech panel. Net effect is I had the benefit to talk to over 500 sponsors, invest personally with about 20, and joke became honest again, joined up with some guys in Dallas, BV Capital. And BV has a strong focus in, I'd say, different parts of multifamily, workforce, student, et cetera. But what's probably of most interest to this audience is teaming up with the Archway folks. They're based out of Houston with a very strong track record in the industrial space. So our offering right now is a cash bond replacement of triple net industrial property. So we move on a rolling close. We're going to keep it honest for a 5-year term and have been paying distributions for 13 months straight. So happy to share more.
Fantastic. And Peter Powers, you're on. I see you. Can you talk about what you guys do?
Yeah. Hello, everyone. My name is Peter Powers. I run the real estate platforms for my family, MPI Family Office, or family office based out of Tampa Bay. We invest in commercial real estate as well as operating businesses. So we have arms ranging from diabetic care facilities, so on the healthcare side, to insurance and banking, and a pretty sizable real estate portfolio. It's about $1 billion and a quarter. About 6,000 apartments, 1,000 self-storage units, and I think we're up to 10 or 11 senior living facilities across the country, mostly on the eastern side of the U.S., but we're starting to open that up across the country. We also have an advisory side we call the Consortium of Wealth. So we advise from families ranging from 50 million in assets to a couple billion in assets. we kind of help, leverage our advisors, our various tax teams to help them, go from, again, wherever they are now to, whatever their goal is. Yeah, so I'm happy to be here.
Fantastic. Ravi? Ravi, you are on mute, and give me 1 second here. Maybe I asked you to unmute, but let me ask you again. Perfect. Fantastic.
Hello, guys. This is Ravi Katta. Background is technology, from Silicon Valley. Sold my company 2008, 2009. I moved to Austin. Since then, pretty much involved in investment side, technology, startups, investments, but also big chunk in real estate. Used to be only multifamily. Now we're doing massive mixed-use developments, especially in Austin. We have pretty big projects. One of the projects is Leander Springs. When it's completed, it's going to be probably $1.4 billion worth of investment. Me and my co-sponsor. Of course, I also launched a real estate private equity fund last year. But primarily, I invest a lot of money from my side. And so we're kind of trying to grow in-house as much as we could, vertically integrated company. So, and help other people to achieve that kind of financial freedom or whatever the thing that they're looking for.
Fantastic. Great. So I'm just going to get to the questions here. Just give me 1 second. So just as a preface to this next question, there was a time of economic hardship in the United States. It was around 1830s, let's say, and the president at the time was Andrew Jackson. Wasn't a big fan of the Bank of New York, which I guess today is Citigroup, and so he smashed it, and he talked about smashing it. But the way he got the U.S. out of the debt that bank had put us into was he sold about $1 billion of real estate to other sources, and the United States actually was debt-free at that point in time. So we're seeing the market go through lots of turbulence. We have the problems with the Federal Reserve. There was problems with COVID, problems with this Ukraine, Russia activities. So I want to just get people's perspective on the next 12 months, where they see the opportunities and where they see, things that might have been great investments during COVID, maybe not so great investments today. So why don't we take it away? Peter, you there? Peter Powers?
Yeah.
Why don't you give us an answer on that question? What are the greatest opportunities in the next 12 months, and what are not so great post-COVID?
Okay. Yeah. So I guess let's start with before COVID. We've been evaluating all the different real estate asset classes for about a decade and a half, and we've settled on housing, self-storage, and senior housing. We've been focusing a lot of our energy on affordable workforce housing as well as the senior housing. We believe now more than ever those I guess two niche asset classes are needed more than ever. So we've been focusing more of our time into providing affordable workforce housing through our LIHTC and our hotel to apartment conversions. And we've also been building up a nice portfolio for senior housing. I'm sure you got hurt. I'm sure a lot of you hear that the 65 and older demographic is increasing at 10,000 people per day. Well, if you look at that, it's actually the 70-year-old demographic is increasing 10,000 a day. That's been happening for the last 5 years, and 70 to 75-ish years old is typically where our residents. That's kind of on the younger side of our residents. So they're looking for places to live, which would be closer to where their children are, or kind of closer to where they have grown up. So we've been buying a lot more of those assets, especially in the last couple of months, just because our new tenants are starting to come back in, and that's starting to be on par to where it was in 2019, 2020, 2021. We were seeing those new leases, they weren't up to what they were before that, just because a lot of people were holding back sending their loved ones to these facilities. So we're starting to put more capital towards that. And then in terms of affordable housing, the workforce affordable product, I mean, I think everyone has seen how much rents have increased over the past, past couple of years, which is.
We have.
Yeah, here's something.
Thank you, Tom. I think we got it. Perfect. All right, let's go.
I think so.
Pete, rewind 20 seconds, please.
No problem. So I kind of made the case for the senior housing, but on the affordable side, I think everyone has seen, what's happened with rents over the past, year, 2 years, how much they've increased. We're well above, we're at record high rent levels right now, and incomes just have not kept pace. So you're starting to see a lot of recent college grads, and a lot of, baby boomers that, again, aren't at senior housing yet, that are on fixed incomes. They need a place to live. And we think these hotel conversions provide a solution to that. We also think LIHTC is a great solution to that. We think it's a very conservative way to invest, but it still offers great return profiles. So that's where we've placed ourselves.
Fantastic. Ravi, what are your thoughts on the market for the next 12 months, and what are safe spaces and maybe not so safe now that we're out of COVID, et cetera?
I don't think a lot is changing, other than, of course, when these kind of things happen, whether it's the Russia-Ukraine situation or the interest rates going up because of obviously the inflation, there will be pressure, obviously. But in terms of opportunities wise, it's there everywhere. I mean, it's not like just only self-storage or multifamily, or it's just that finding the right locations and right asset types for that location is what pretty much matter. But generally, what we are pursuing, or what we have seen, is most of the people are looking towards live, work, play kind of settings. That's why that kind of developments are getting popular. And then also, frankly, with the COVID kind of thing, people don't want to drive, right? So whenever there is a live, work, play kind of setting, like take an example of Domain in Austin, right? It's a perfect example. Nobody need to drive anywhere. They can go to restaurants and they can go to work. They can pretty much live there, do the shopping. It's 4 o'clock. So that's been what we are noticing. And then, and I've compared that the same theme with a lot of other cities, even Bay Area, California. Cupertino used to be pretty old downtown. Now it is thriving mixed use, live, work, play kind of setting. So every city has those things evolving. So that's why I got into that kind of side. And then we're doing, obviously, building like 1,600 apartment units, 1 million square foot of commercial with a hotel and Crystal Lagoon, a lot of those things. I think that's probably is going to be the direction for younger population, for older population, for generally anybody that's kind of trying to find quote unquote work-life balance kind of thing. So that's, I would say that.
So you're saying convenience matters, and at the same time, I mean, there's no doubt there's been a huge deficit of housing building over the last, since 2008, right? So I guess maybe another way to put the question is, what's going to happen to all these people, like restaurant owners who didn't pay their rent, apartment owners who didn't pay their rent, people who have mortgages who didn't pay for 2 years and are looking to catch up on that? Are we looking at a 2008 scenario again? So why don't we go to Ryan on that? Okay. Or Ravi, if you want to answer, you feel free to answer.
Sure. I think I don't think it is going to go to 2008 scenario, but of course there will be a lot of pressure. I think I wouldn't say a lot of foreclosures or anything like that, but I'm sure there will be a lot of properties coming into the market. So whoever sitting on the cash, whoever can take advantage of that one, it's going to be an amazing opportunity. But I don't think it's going to go back to 2008.
Fantastic, great. So, Ryan, can you talk about where you see the next 12 months turbulence? I mean, a lot of guys here are insulated. They're doing a lot of business in Texas and in the South, and I think there's probably less impact than on the coast. But Ryan?
Yeah, where we see opportunities, prior to COVID, we were in office and industrial. And then COVID hit, and obviously we tapped the brakes on office. We kind of pivoted to medical office. I have a background in that, and what we found is, we're sitting down interviewing tenants, and when we're buying property, we found, the doctors are still seeing patients, and paying rent and those type of things. So we went out during COVID and picked up, 2 assets at really good prices. I mean, we're a basis buyer, so we're always looking for a pretty steep discount to replacement cost. The other piece is industrial, and it's more on the light distribution space. So you just think suites, 2,000 to 30,000. So you're not in these large Amazon distribution where there's just ultra competitive. The problems that we see is there's so much capital right now. And everywhere you go, it's very competitive. My team focuses on off market or soft marketed deals for that very instance, because once JLL or CBRE or whoever gets a hold of it, I mean, there's 15 bidders, from sovereign wealth funds to local folks to that. So we really feel like the real estate opportunities, it's a people business. It's who you know. It's having a good track record. It's closing. Those are the main asset classes that we've kind of focused on. I do think with interest rates increasing, there might be a lag in deal volume, just because sellers are the last ones to kind of change their expectations. So that will be an interesting thing to look at the next 4 to 6 months.
Dan?
All right. So if I had $3, I put $1 in industrial, $1 in storage, and $1 in something I'll call mobile housing. So industrial, we all talked about, especially in Texas, last mile, don't compete against Amazon in case you want to pay a 2 cap. But the nice thing here, this is basically bond underwriting. You're going to get, frankly, a monthly distribution, no real surprises. Think of this as your cash bond replacement. Storage, it used to be the 4 Ds. So death, divorce, displacement, what's the other goodie here? Dislocation. There's a 5th one, I think, post-COVID, which is decluttering. You don't want to feel like you're a hoarder. You need that space. You need that extra bedroom. And frankly, you can't find it, especially in hot markets, say Austin, to find a 3-bedroom to rent, to find an extra space in the house. Storage becomes a natural extension. So while in the macro, supply might equal demand, there's a lot of upside. I have some buddies that raise rents 80%, and guess what? They can do it again. And finally, with mobile housing, so many not so great events through natural disasters, war, etc. You're seeing folks, and I was actually here at a South by Southwest event where a few colleagues of mine built a hexagonal drone that can be put in. It's basically a smart house and stacked on each other. Absolutely amazing, patented. I just think it's part of the future versus, people trying to wait so long to build. People are going to want that service, frankly, for the piece of humanity a little bit earlier. So personally, I think this is that last dollar. This is your 100x sort of opportunity. So I would suggest, whether it's on the defense side or somebody that's calling on the human side, look for some of these opportunities.
And by mobile home, are you talking about people living in RV parks, or are you talking about mobile home parks?
I mean mobile from being able to pick up from A to B, and B might be 800 miles away.
So it's RVs then. Got it. Okay, interesting. Yeah. My only comment on mobile home is that they really don't build too many mobile home parks anymore, and especially in municipalities. But it's been a fantastic business for those people who are selling the land.
And just to be clear, this is more of like an ADU that can be picked up and moved versus your traditional mobile RV. So sorry, I couldn't think of a good word yet, but I was just amazed when I saw it today. Thanks.
Fantastic.
Carriage home, like a carriage home.
Great example of one, yeah.
Fantastic, great. So Ryan had talked about interest rates a little bit. Can you guys talk about interest rates? I know that Ravi had talked about convenience. And even though energy does find its way into moving into big cities, your cost of electricity goes up. So oil does impact you one way or the other, or coal or whatever. Can you talk about, the impact of interest rates on different strategies that are out there? Peter, then Ravi.
Yeah, I think a good transition to what Dan was talking about. I think the issue right now with the carriage homes, we've looked at doing a bunch of them, is just the financing's not there. So it's priced totally differently, totally different than, you look at some of these other, housing types of structures. So I know if we were looking at doing it and then selling it to a home buyer, we could build it for a lot cheaper because you can manufacture the homes and they can be mobile like you stated, but it's hard to get the 30-year financing. So that's kind of what pushed us away from that. In terms of interest rates, I mean, we're very cognizant that there's definitely going to be some hikes. Interest rates are going to go up a good bit over the next year, 2 years, but we don't think they're going to be able to push them up, eight hikes or 2% over the next year. I mean, if you just look at how much of an issue that's going to be just for our federal government, and then look at how much of an issue that's going to be for a lot of homeowners that made purchases over the last year when interest rates were being so low, and how it can cause a lot of them to go underwater. That's a big issue. I know a pretty big group I'm based out of Tampa Bay. I know another group based out of Tampa that they were the biggest buyers of these foreclosed homes back in 2008. They bought, I think, 30,000 of them and sold them off to a giant institution. But I have conversations with him once a month about some of this, and it's just how much of a problem that's going to be for a lot of these people that only put down 3%, 3.5%. I just don't see our government being able to push rates up that high and potentially putting these people underwater. So I think that's a huge problem. In order for us to kind of hedge some of our interest rate risk, we are doing floating rate debt on our multifamily on some of the more value add conventional products, and putting into effect interest rate caps, so 3-4 year interest rate caps, which are pretty pricey right now, but it's nice to buy those and be able to sleep better at night. And then that's a big reason why we're doing our hotel conversions. I mean, there's just such a big spread between our yield on cost and where interest rates are now and where they will be in the next year or so, that we have enough cushion. So we've positioned ourselves in a way where it's a little bit more creative, but that's creating more value, which again gives us more cushion.
Ravi, the impact of interest rates?
I'm sure it's going to hurt a lot of buyers on because obviously purchasing power goes down, and I'm not 100% sure whether the overall how it's going to really affect overall the demand, because there's not much supply there. So I think it'll work out itself. Like Peter said, they may not be able to increase it crazily, but it'll go up over the period of next 2 years. Yeah.
Great. So let's move on to the next question. So I'm going to ask everybody to take maybe the most 3 minutes to answer this question each, but I only want people to spend about 30 seconds, 2 minutes on the first part of the question, and then give us 2 minutes on the second part of the question. So the first part of the question is discuss the sector you're in and why you're in it. So don't spend too much time on that. And then tell me, what are you doing in that sector in the next 12 months? Why and how? So why don't you start off, Ryan? Ryan?
The sector we're focused in on is it's definitely industrial, and I think Ravi hit a point. There's not a lot of supply. So a lot of the assets we're targeting are supply constrained. There's not land values are fairly expensive. So we're focused on kind of that covered land play type product where you can buy it, you can cash flow it, you can build some value, and then if you're a long-term holder, which a lot of family offices are, you can potentially sell to a developer. So that's where we're seeing opportunities.
And what are you doing in the next 12 months in that space? I mean, are people converting malls into industrial? I mean, like where's the new supply coming from?
Yeah, there's definitely conversions. Malls are, this whole evolution of Amazon and where, while I still believe you do need bricks and mortar retail, that a lot of that has kind of, you're repositioning some of that to warehouse space, in large spaces where you can receive 18-wheelers and whatnot.
Gotcha. Yeah, we had Wharton Equities on, and they sold 3 properties to Amazon in the last 2 years. And their big play was robotics-ready warehousing. So it was ready to put Amazon robots into it, so that you have to have a different configuration to have that kind of industrial space. And I think that probably more people who are selling industrial will be robots ready, because everybody's going to have to be able to do this sort of industrial with same day delivery. You know, all logistics parts just have to be ironed out. So anyway, Dan?
Yeah, so Ryan shared it eloquently, but we're also eyeing industrial triple net properties that are quote unquote mission critical to the operation. So this can be anything from a Loomis, Fort Knox on the border, to your typical industrial park with 5 to 10 buildings, to a 3PL. So we're going to look at that. Personally, as you said, storage, I've been fortunate. I've been in it for over a decade now. There's still a lot of meat on the bone for two reasons. One, on the demand side that I'd alluded to previously. Other, on the supply side, 4 out of 5 storage units are still owned by mom and pop grandpas that, frankly, are not the most sophisticated when it comes to revenue management. So storage is still great. It's still an industry where you can still outwork somebody. It still takes effort to actually find the owner and speak to the owner. So once again, a lot of upside in storage.
So it's highly fractured industry, storage, right? Maybe at some point somebody can talk about data centers at some point. But why don't we get on to Ravi? Any thoughts on so what you're looking to do and what you're going to do in the next 12 months?
I mean, traditionally we've been multifamily, but now we kind of moving more towards mixed use development with combination of all those pieces. So that way it becomes easier for the next generations, or even the people that are retiring, etc. I think there is play for there. And then the second area that we're trying to focus is acquire a big chunk of land, like 1,000 acres or somewhere there, and then go with build to rent kind of model. We're doing one project, a smaller one, not big, a couple of 100 units, but it's a build to rent model is another one that I think will probably go full-fledged. And even mixed use development side, live or play, there also the model that we are choosing to go is not necessarily like buy a land, entitle, chop it and sell it. What we are trying to do is buy the land, entitle it, and build in phases with whoever is like-minded partners. It could be bringing in one more GP or whoever that fits into that kind of model. So mostly towards how can we maintain these things for a long time to come, or as long as you can control and then operate it. That's the model we are going.
I think build to rent is a really fascinating space. So I just had a guy I talked to last week, and he was telling me that, you know, this guy's gone from about $5 million under management to like $1 billion in the last 5 years in the real estate space, and it's almost all built to rent. And he just says that it's astronomical, the number of investors who are looking to get into hard assets of owning apartments, and they're not necessarily big corporations or big real estate funds. They're just high net worth individuals who want to be able to invest. And so I did not know this, but it is possible to buy large apartment building units, like what do they call them, like apartment communities, I guess, where you might have, it's, you know, 1, 2-story apartments, 3-story apartments. It's 400, 500 doors, and people can buy parcels of that inside. So you've got a totally distributed product. And what he told me was that apartment communities are pretty much operated by 5 companies, and one of them today has the ability to have totally distributed ownership of a large apartment community complex, which changes, to me, it changes the whole ballgame. It's something recent over the last 2 or 3 years, where you can have 10 high net worths or super high net worths come into a community of 400 units, and they can all distribute 10 to 50 units between themselves, and then come up and be able to consolidate data to report it directly and have, you know, all of that, the aspects that you need to do. So it's a fascinating twist on multifamily. And I think it's probably the future, given that there are lots of people out there with cash who want to invest it, and they don't want to be in the market because they feel that real estate is a more consistent investment than others. So, Peter, any thoughts? Peter, you there?
No, I'm here. I don't really have anything to add to that. Again, we've been staying with, in terms of our residential, I mean, I kind of went over it. We haven't really been doing anything too creative except our conversions. That's pretty much been it. But we've stepped on the gas a little bit with our senior housing to build that up more.
And how big are you going? And can you talk about your geography of what you're looking at in senior housing world?
Yeah, so senior housing, we focus on private pay. And for that, it's, we're buying, we kind of call them the continual care facilities. It's not full continual care, but we'll have the assisted living and the memory care. Sometimes we'll also have the independent living. So it could transition from the independent to the assisted to the memory care. But I'd say, typical properties, between, 90 to 120 beds. So let's just say 75% of those or 80% is going to be your assisted living, and the remainder would be your memory care. Most of those have been on the eastern part of the U.S. So, Tennessee, New York, Pennsylvania. We're making an investment in a newly leased up community in Lincoln, Nebraska. We'll close on that in a couple weeks. But besides that, it just comes down to operations. Right now we have 2 operators that we do strategic joint ventures with, one based out of Florida, one based out of New York. And again, they've been in business for multiple decades and have demonstrated their expertise and understanding what seniors want, and again, how to work with the various different structures to various different payment structures. It's all private pay, but there's ways to kind of get creative with it. That's the biggest thing for us is the operation side, because that's more of an operating business than it is an actual real estate business.
And Peter, you guys are a long-term hold. Is that correct? You're not really looking to get in and out. Like if you run a fund, obviously you're looking to get out within 5 to 10 years. What's your orientation?
We underwrite for 5 years just to get an understanding. I mean, our rule of thumb is we want to at least be able, when we underwrite an investment, to double our money every 5 years. But that doesn't mean we're not going to have some assets that we hold on to for an extended period of time. I mean, you have to underwrite at some time frame, and 5 years is typically what we pick, just because we typically pair it up with 7 to 10 year debt. So 5 years is gives us at least another couple years, just in case if we're in a bad part of the market at that 5 year mark. But a lot of these properties we expect to hold on to for 5+ years. So not all of them are crazy long holds, but some of them definitely will be.
Great. I'm going to ask this next question to Dan. Can you guys give a case study of like a deal that you guys have done in the past, or a deal that you're looking at putting together? And can you just talk about whether the company is vertically integrated or not, or what are the logistics or how do you guys operate?
Sure. I mean, being local to Texas, for being boots on the ground the last 40 years, we tend to hear about particularly smaller deals. I know Ravi talked on some of the smaller deals, but these are things we're going to bring to our investor base. And it's a heavy 506c accredited investors, family office, fair amount of RIAs that come through. So with that, anything we're going to bring is going to bring usually not a long term, probably about a 3-year term with a 20+ IRR, and it's going to have what I call a fun story behind it. Meaning, to your point, Marty, the property manager take on a workforce housing is going to sit in our office, because we want to get to know each other. For our investors, we don't want somebody sitting even a few miles away to grab their few points of management fee, or something like a student housing where we know we don't have the deepest expertise. We're going to partner with somebody that maybe has worked on that property as an analyst in the 90s, and they've been managing it for 10 years, and now we're the owner. And then finally, if it's a segment that we don't have deep expertise, we'll look for somebody like a Cantor Fitzgerald or a large, I'd say, top 10 shop out there that we can do warm introductions for our investors.
Sure. Ryan, can you talk about like a case study of a deal that you did recently in the last year or so that turned out really great, and something that you're looking to kind of either replicate that, or maybe it's just a greenfields opportunity that you underwrote that you think is pretty excellent?
Yeah, like I said at the beginning, we represent families and high net worth investors in direct investing, and my firm is vertically integrated in the sense of we do the acquisition piece. We have an acquisition team. We have an asset management team. We have a subsidiary that is actually a brokerage house. So we have brokers that are out sourcing deals and whatnot. But we had one individual actually sold a cold storage portfolio for $300 something million. He allocated $40 million to us, and we went out and actually started buying retail strip centers, because what we when you say retail, everyone's like, oh, it's a four-letter word. Well, big boxes, malls are okay, I get that, but the retail strip centers predominantly have done very well, especially in Texas. In Houston, the vacancy rate is less than 5%. So they've done extremely well. They're great cash flowing assets. So that's we bought 2 assets in San Antonio that kind of make up, kicking out 7% on their money. And a lot of our clients that are doing this, they're replacing fixed income with private real estate, because you can't make that on the bonds, so it's it's a tangible asset, and you have it's kind of like a hybrid, right? Because it's fixed income and the cash flow, but then there's usually appreciation on an equity kicker on
are the strip centers that you're looking at, or do they tend to be more high end or middle or low end? Or
I would say middle. A lot of it is new construction. Just think, it's all about the tenant mix, right? So when we bought these assets in San Antonio, you had a restaurant, but then you had the UPS store, you had a dental office. We are seeing a lot of medical go into retail, which is great, because medical tenants tend to sign 10-year leases. And so when you're trying to get out of that, and we're the same way. In 5 years, we underwrite everything for 5 years, and if you want to get out of that, having a 10-year lease kind of helps.
I gotta think that the tenant mix. I mean, if you're like in Dallas, for example, the amount of strip malls that they've torn down and put up far higher, class versions, it's a big number, right? I mean, if you drive from Dallas to Plano or any of that area, I mean, it's phenomenal how many high end shops they put up. So that's talking about tenant mix. So, and are you guys acting as developers as well, or?
We do not do development.
Okay.
We're strictly buying existing assets.
Yeah. Yep. Perfect. Great. Peter, case study of what you guys have done, in the last year or so, and what you're looking to do. I know you talked a lot about assisted living, senior housing. So
yeah. So I think I better want to be our hotel conversions. So we've been making, I think we've made 8 investments into 8 different hotel conversions over the last year with our operator that's based out of California. So these are typically extended stay hotels. I can think of one right now that's an extended stay in Texas, not too far away from you guys, in New Braunfels, Texas, so right between Austin and San Antonio. So it's right along that corridor, about 45 minutes to 50 minutes from each city, but it's very, very well located. Your all-in basis on these deals is, typically on that one, I think we're coming in right around 75,000 or 80,000 a unit. Yeah, they're smaller units, but in a market where average 1-bedroom rents are north of $1,000, and we're able to provide rents starting around $800. That's very attractive to residents when you're 20% below the nearest comp, and you have far better amenities, because you're taking those common areas like a conference room, and you're converting it to storage and co-working, and you still have a nice pool, and you really do have Class A features, even though the units are typically 400-ish square feet. So again, I gave an example of how this is good for recent college grads, as well as baby boomers that are on fixed income, and that's typically who we see renting up this type of product. So that's one I can think of right now, and it's, again, our all-in basis. It's incredible. So it's a total great basis play, which I think is a defensive way to invest in real estate right now, given the uncertainty that's in the markets.
Ravi, your thoughts? A case study that you've done in the last year or two. Why was it a good deal? What are you looking to do similar this upcoming period?
Traditionally, been multifamily value add, but last year we kind of got into various areas, like I said, mixed use, build to rent, and a multifamily with like 60,000 square foot of commercial ground floor, Cedar Park downtown. Going through the entitlements, etc. It's an amazing opportunity. The kind of course, the Cedar Park is growing crazily. So just within a year, I mean, you are sitting in an amazing situation. Okay, that seems to be the thing working for us. So we're kind of going more and more into that side. So buy the land, entitle, build it, and then keep it as much as possible, as long as possible. That's so. Otherwise, we are a vertically integrated company, pretty much finding the deal to underwriting to property management, asset management, pretty much end to end. So not necessarily we do actual construction. Obviously, we're going to engage somebody who has done that kind of specific construction. For our Leonardo Springs deal, we are actually looking for great GCs. So we interview the right people and then pick the right one. So yeah, that's how we do it.
Great. So can we talk a little bit about the demographic trends? I mean, so maybe it was 10 or 15 years ago, somebody came to me and they said, hey, you know, I run what was called a five and dime store, but I guess they're dollar stores now. You know, I ran a warehouse. I was importing stuff from Japan. I bought a warehouse in Brooklyn, and then I started importing stuff from China. I bought a second warehouse in Brooklyn, and I want to get rid of my business. You know, my kids have no interest. I put them through medical school and law school. They want to do something else. And he didn't realize it, but you know, his industrial property he owned was worth a fortune. It's like worth north of $100 million in the middle of Brooklyn, right? And it was done. It was purchased, and it was a condo conversion. And so it's a funny story because it's a natural cycle, at least in New York, of a lot of industrial becoming condos, and now there's a shortage of industrial in the area. So can you guys talk about demographics? I mean, you've got people who want to sell businesses, you know, industrial that was converted into living back in the, you know, 2000s, early 2000s. Then you've got a need for industrial now because of the way, you know, retail is done, delivery, et cetera. You know, Ravi, why don't you take that one? You're up already.
Yeah. So,
what's the impact of demographic trends?
I mean, there is significant, like, I mean, I can take in different direction. One of them is obviously like everybody's, like a lot of people are retiring, etc. So it definitely there'll be a lot more need in that side of the thing, and then that area is going to thrive very well. I think some of you guys focus on the senior living, etc. And then the other front, lot of the high net worth individuals tend to be going towards, like I think somebody pointed that thing, they wanted to buy and hold it and then keep it versus being part of a syndication and then just go through that cycle.
Absolutely. I think that's a big trend, Ravi, which is that high net worths want to, because of the tax advantage aspect of it, to some of them, a 5 to 10 year hold might not be desirable. They might want a 30-year hold or longer, right? So keep on going.
Yeah, so on that one, actually, a simple example. I mean, I'm all my circle, like from Silicon Valley, high tech, high net worth individuals. So, I mean, of course, they're putting money into my fund, etc. But some of them, after putting like $250,000, $500,000, they say, "Hey, find a deal. We'll get you $2-3 million or whatever is needed, but we want to keep and hold it." So that's the kind of trend it seems. Last week, somebody flew from California, and then he's sitting on like 300-400K, and then he says that, hey, tell me if there is a deal that we can buy and then keep it for a long time. So it's kind of, that's a trend we're seeing more and more now.
Right. I'm seeing a lot of, like, I have guys that have made so much money in crypto, for example, or in tech, and they're like, how do I convert like a little bit of this into real estate, right? So that's a big issue, right? So yeah. Ryan, we'll get to Peter later. Ryan, what are your thoughts on, you know, the changes in demographics and you know, how that is impacting real estate?
Well, I think office, for instance, is going through what retail went through when, you know, Amazon kind of came to the show. You know, we own some office assets, and you know, office isn't dead. I can tell you that's a fact. It's going to change. It's going to change how much space you need. It's going to be, not everyone's going to be in there Monday through Friday. But at the end of the day, we were sitting down. We're buying an industrial facility. We were sitting down with a tenant doing our tenant interviews, and he was saying productivity right now is terrible, just because you can't collaborate, you can't do things. So I do think on the office sector, You're going to see an evolution of how people use space. They're going to use less space. There might be some more consolidation, but there could be some buying opportunities in the office.
I guess the question, Ryan, is that for years I worked in consulting when I came out of Wharton originally, and actually I worked in it before Wharton. But in consulting they have what they call the whole pieces of hoteling, which is that you're never in the office, so all you do is you get a desk, like it's a virtual desk. You get to come to the office once a week, twice a month, and you get a desk, and you can turn on some digital things, and then you're out and you're on the road again. So are we seeing a mass migration towards hoteling? Is that what's going on? Because that's like the thing that everybody's talking about in New York right now, is that people just aren't coming into the office anymore. They feel like they can work from home or on the road. Any thoughts on that, Ryan? You're kind of the expert on that space.
Goldman Sachs came out the other day and said they want everyone back at the office. So that's why my point is it's evolving. I do think there's this migration, especially with the millennials. They want a very tech atmosphere in the office space. So I do think in order to attract talent, you're going to have to evolve on that office space. It's not going to be your traditional, exterior offices and a cube. It's going to be just more open space, conference rooms, where people can come and go.
Great. Dan?
I think it's what folks want in their portfolio, whereas before it was stocks, bonds, cash. Now, particularly when, say, grandma and grandpa's about to pass or when they're going to gift, I think families in particular, I think John, one of our panelists before, shared, a lot of independent advisors are having a holistic view to say, what do you want to own? And I think the experience with the high printing of the money in COVID, folks want to own assets and they want to gift assets. And you don't want to sell half of your family's worth today, because if you did that in 2020 and then, who knows what part of the world you're in, where it is, inflation, et cetera, you're SOL really quickly. So you can argue, we're going back a few generations when it's how much did you own, maybe a little feudal system, so to say. But I do think it's very powerful. I think folks want to have something tangible as a significant percentage of their portfolio.
Peter, I know that you already discussed, demographic trends and 70-year-olds moving into senior housing. Do you see any other impacts from changing demographic trends? A lot of people are moving from north to south, like some of the greatest, besides Austin, Texas. You see Tampa, Florida growing dramatically, Orlando, Florida, a bunch of hedge fund guys have moved to Miami and Palm Beach. Your thoughts?
Yeah, it's going to continue to happen. Lifestyles changed since COVID started. So you look at even restaurants now, the whole experience. Some of our hotel conversions, when we had giant restaurants in place, right? Well, what are we going to do with some of those? We're going to make them into cloud kitchens. We're going to bring in an operator and we're going to make them into cloud kitchens. So that experience has changed. Let's look at work. I think people will start going back to the office. At least most companies will, at least part-time. They'll go in a few days a week. But again, it's very hard to give people a taste of work from home for 2 years and then just say, oh no, you got to come back. Things change, things adapt. So work wasn't just one of them. The dining experience is another one. Places are different. We're starting to put some of these co-working studios into our communities. It's being asked by residents. It's when we can show them, like, listen, we have Wi-Fi included. Maybe 1 or 2 days out of the week where you don't have to go to the office. You could just work out inside your unit, or you can go into one of the co-working spaces. I was just in Baltimore. We're buying 2 towers right now, and we have altogether probably 30,000-40,000 square feet of conference room space. One of them is a giant ballroom. Then we have a bunch of smaller conference room spaces. We're going to make 3 of those into co-working studios. So, it's going to work out very, very well. And again, it's just, I look at, people, my age demographic and, other age demographics, when, you talk to a lot of them, and that's, some of them are making, $50,000, $60,000 a year. And some of them are making upwards of over $250,000 a year, and they're working from home. That's anywhere from New York all the way down to Florida. It's the same thing in Florida. So I think that's definitely going to be the future in a lot of different areas. And, as employers, we're just going to have to adapt to that. And as landlords, we're also going to have to adapt to that and provide that. So that's what we've been doing. And we think, again, that's where things are going to go. And that's going to be, it's going to be a requirement from a lot of prospective employees. or
We have a
new
question from the
hires?
audience.
Yeah. The term Sun Belt goes around so much, and it reminds me of the taxi cab driver that whispers in your ear, buy this stock or that stock. And so from an allocator of capital, recognizing the demographic trends, people moving into the Sun Belt, I get that. But what can an allocator of capital to real estate look for to identify when supply exceeds demand, when everybody's project comes online at the same time?
So well, it's a fascinating question. So I guess the question is, at what point do you discern that there's too much supply, which, is fascinating since we've been building housing at about a 50% deficit a year since 2008. So in terms of housing, there's no oversupply, but maybe you guys could, maybe the question is, where do you see oversupply, maybe outside of office, in real estate right now? And how do you judge when you're looking to invest or build, when there is oversupply or not? So I'll shove it over to Dan right now. Dan?
Sure. Honestly, I don't see it. I mean, for housing, for other reasons, there's such a lack, and folks want more of their liquid going into something hard, and they're going to bump that up. So I think the demand is what percentage of their assets they want in real estate. There's still a lot more money that they want to place across anything. So it's something physical that they can hold, touch, own. So I think it's a while. I defer to Ravi. I don't have in the next 2 to 3 years, I don't see anything where we're going to say, oh yeah, crazy oversupply.
I might say maybe office and mall, but Ryan, what are your thoughts?
I do think there's a ton of development in what I would call big distribution. We've chased some assets in Austin, and I mean, you got institutional capital come in and buy a shell at a 3 cap. That's just not something that we play in. So I think deals are based on where capital wants to go, and they want to go in multifamily and they want to go in industrial. And the industrial that they're going into is Class AA, Amazon type facilities. So I could see some supply issues on that front, but like I was saying, what we focus on are the smaller tenant space, which those aren't being developed because they don't pencil because of labor and land costs and things like that.
Yeah, I'm going to call that distributed industrial, where you might be just as effective running a smaller industrial shop than an Amazon-sized industrial shop. Ravi, your thoughts?
Yeah, I mean,
how do you judge when there's too much supply of something?
I don't think the question that the person was asking, it seems if you see it a little bit differently, you don't need to worry about the oversupply at all, depending on what location, city that you're picking. So let's say you pick Austin, or maybe to some extent Dallas, or maybe Nashville, or some of those thriving areas where all the companies are moving, all the jobs are happening. So lots of migration happening. So you pick those 6, 7 locations in the US, there is no issue at all. I mean, you can put whatever the money, it'll be fine. Yeah, market might correct a little bit, but they will come back fastest. And then you'll be fine over the period of 5-10 years. So if you see it that way, I think you should not worry about oversupply thing. Of course, you got to pick the right kind of assets like multifamily or even warehouses, etc. But you don't need to go into other areas that are maybe get affected too much based on what economic cycle or what kind of situation that you are in. But otherwise, yeah, you can put whatever the money, it doesn't matter. That's how I do it. I mean, I don't mind putting a lot of money into real estate because I strongly believe in as long as you pick the right kind of asset class, right location, etc.
Peter?
Yeah, so I mean, one of our big platforms is affordable housing, and I mean, I really don't worry about it. I'm going into markets that are just overall 96, 97% occupied. When it comes to affordable housing or workforce housing, it's near 100% occupied. I mean, development costs are just way too high right now to be able to provide rents ranging from $850 to $1,300. So I go into those markets, I feel very comfortable that when our all-in cost is we come in way cheaper than anyone else, our rents can be cheaper and we could still make great money. So that's why I feel like on that side of it, on senior housing, it's such an experience. We do look at supply, and I mean, obviously look at the supply in the market. So markets like Atlanta, it's very tough right now because they've developed a lot of senior housing. But you go into some of these, some of these pockets, areas we typically want to go into, like Lincoln, Nebraska. It's had multiple generations of families, have lived there, and they've accrued a lot of wealth through, farming or whatever their business has been. Those are great areas to have senior housing, because again, one, we know we can provide a really great service and for those residents, but two, it's you're in an area where they can afford it because they've made a lot of money in the businesses that they've been a part of there, and they also have multiple generations of family there, and that's typically where you want senior housing to be. So we're able to go to some of those areas that we typically wouldn't if it was just traditional multifamily or if it was self-storage.
So we're going to get to the last question as we run out of time, but I'm going to preface it with a bold statement. I'm going to say that all real estate in the United States is undervalued. And the reason why is because only now are we doing things like crowdfunding, asset tokenization. We're looking at ways to invest in shorter durations, longer durations where it might be more tax beneficial to the investor. So can you guys talk about, do you see most real estate as being overvalued, undervalued, just right? What are your thoughts, Ravi?
If you take a smaller time period, they're probably overvalued right now because that's where you are in the cycle. But if you see in the longer cycle, definitely there is a lot of upside. So it probably undervalued in the longer period. So
my thesis on undervaluation is that in most large scale real estate, only institutional investors can get into it. But if you let retail investors get into it, it would do another step up in valuation, right? And I think that's where we're heading in real estate, is retail investors are going to be getting into that. So, Dan, what are your thoughts?
Yeah, I think it's a buy high, sell higher market. And, my reference point, Ray Dalio's Changing World Order, we at the US are kind of dipping, they call it stage 5. China's going up. More money is going to be printed one way or the other. So I think it goes back, but for nominally speaking, a whole lot of things are going to go up. So I think you're pretty safe. Lock in the rates. If you're vesting as an LP, either be real short term for double digits, meaning a year or so, or have a pretty fair promote on the back end.
We live in cycles where hard assets have to make up way quickly for when they inflate the currency, right? So, and that's what Andrew Jackson did, right? He sold real estate. And even in 2008, we had a special dispensation on the Foreign Currency Act, which allowed Russian oligarchs and Chinese generals to buy housing in Miami without any kind of inspection. So you heard about, the Russian oligarch who bought his daughter, who was a college student at NYU, a $50 million apartment in New York City, for example, right?
I agree with what Dan said. And if you look at the retail, all the major institutional shops are now opening it up to retail investors. Like for instance, Blackstone, they do wealth management now, right? So they're tapping in. So I can see this with crowdfunding, with the retail investor, with the IRA, the 401k, the guys that are doing 1,000. I mean, there's just going to be there already is a plethora of capital. And I just think it's going to keep adding to it.
Right. And I'm going to say that crowdfunding had limitations on how much it could do. I think now the limit's about $5 to $10 million of crowdfunding on different projects, and you're going to see it get bigger. And you might even see, so in the hedge fund space, you have what you call like feeder funds, where people aggregate a bunch of smaller investors into one, kind of leg of an investment. And you'll probably see that from crowdfunding, where people will consolidate a big crowd into several $1 million, and then institutional will come and do another leg of that, and people will figure out the logistics of how to get all that done. Peter, what are your thoughts? You're the closing statement here.
Yeah. I mean, we're already seeing it. We have a big operator that is in the senior housing space, been in the business for 30, 40 years. And they're looking at it. They're like, why work at these giant shops when, we could figure it out where maybe, you as an MPI comes in for a good chunk of it. And then we bring in the rest through just more of the retail investors. You know, they can get better terms that way, and they can structure deals more flexible. So we're definitely seeing it there. And I think a big part of it is, you know, when you're seeing, you watch CNBC, you watch any of these, you know, programs, it's, you know, they have all these different syndications, whether it be Fundrise or whatever it may be. So, you know, a lot of investors, you know, high net worth, ultra high net worth are seeing that, and then they're demanding it from their, you know, their RIAs or wealth advisors to get involved in it. So, you know, we've had a couple reach out to us that want to co-invest with us because they don't have the deal flow. They don't know how to look at the deals, but they know that they have a certain amount of investors that want to allocate money towards it. So they've shown more interest. And I think at the end of the day, that's who's going to push those typical wealth advisors that typically do stocks and bonds to go into, you know, the alternative assets like apartments or self-storage or office or wherever it may be.
Absolutely. Well, listen, guys, great job. Fantastic. I really appreciate your participating.